Okay, hi everyone. This is going to be the second lecture for Chapter 18. Last lecture we talked about earnings and profits. We said it's a proxy for economic income. It's kind of like book income. One of the reasons we said we care about earnings and profits is because it helps to tell us whether a distribution is considered a dividend or not. Now, where we're picking up in this lecture is we're looking at the specific ordering rules for determining how we would calculate a dividend, or in light of the balances in our current earnings and profits as well as our accumulated earnings and profits, we have to follow certain rules. Now, there's four scenarios here, right? We can have a distribution when current earnings and profits was positive and AEP was positive. We can have positive, negative, negative, positive, and negative, negative. So generally, right, when we have a distribution, we're going to start and draw from our current earnings and profits, and then thereafter, we're going to draw up from our accumulated earnings and profits. So now we're going to look at each of the four scenarios to kind of show them in their specific format. So if it's a positive, right, it's one of four. Distributions come from current earnings and profits first. If the distribution is greater than current earnings and profits, then what we do is we allocate it pro rata to all of the distributions made during the year. So based on ownership interests, any distribution out of A, E, and P is going to be allocated to the recipients chronologically based on when the timing of the distributions were made. This is important when the shareholders' ownership percentage changes during the year. So that's a mouthful. Let's look at 18.4 here to kind of give this some setup here. So, right, we have scenario one of four. It's positive, positive. And it looks like a corporation has 40,000 CEP and AEP of 16,000. At the end of the year, the corporation distributes $48,000 to shareholder one and 16,000 to shareholder two. So I have shareholder one over here, shareholder two over there. They want to know how are we going to characterize this? So the first thing we see here is the distribution is greater than, so for shareholder one, in this case, our distributions are greater than our current earnings and profits. So that means we have to apply the rules here pro rata based on ownership interests. So when we're drawing from current earnings and profits first, we would do just that. This guy, shareholder one, owns 75%, shareholder two owns 25%. So that means of the current earnings and profits of the 40,000, we're going to allocate 30 to shareholder one and 10 to shareholder two. That's going to be the dividend first that comes from CE and P. So we distributed 64, right, in total. We just allocated 40 of that. We now have 24,000 remaining. So of this 24,000, right, we have to, in this case, deplete our A, E, and P, which is 16,000. Remember, you do C, E, and P first, then you go to A, E, and P. So in this case, we have 16,000 A, E, and P. So we're going to do it pro rata here, 75%. So 12,000 to shareholder one, 4,000 to shareholder two. We just ate up all the A, E, and P. So you go through C, E, and P, then A, E, and P. In that, we said, okay, we have a shareholder one. They're going to have $30,000 of a dividend from there, $12,000 from there. What that means is they have $8,000 left, right? Because they got 48. We accounted for 40, and we accounted, for 30, and then 12. So that's 42. We have 6,000 left. That's going to reduce our basis as the shareholder. So if you want to just think about this high level, right, we have two shareholders. We have a positive, C, E, and P, A, and P balance. We do it pro rata, meaning of the distribution, 30,000 goes to CE&P for shareholder one, 12,000 comes from AE&P, and $6,000 is a return of capital, reduction in basis. So they got 48 total. That's how we broke it out for them. It's not, again, remember, it's not just a simple, it's all a dividend. You have to look at the CE&P and AE&P balances. The next one here, it says a corporation has CE&P of 40 and AE&P of 15. The shareholder, who's the only one at the beginning of the year, receives a distribution on 6/1 of 45 grand. After 6/1, that shareholder sells their shares to shareholder 2. At the end of the year, shareholder 2 receives $15,000 distribution. So basically, we have a shareholder, they get a distribution halfway through the year. Later, they sell their stock. We have a new shareholder, they get a distribution at the end of the year. Now, this thing is showing right here that we're going to be doing any distribution out of AEP is allocated to recipients chronologically based on when the distributions were made. This is showing that right here. So in this case, we need to allocate the CE&P between the two distributions. The total in this case, $60,000, right? We had a distribution for 45 and 15, so we have $60,000 total distribution. 45 was in distribution 1, so that means 75%. So of the CE&P, 75% is namely $30,000 is going to be to distribution 1. The remaining 10 is going to be allocated to distribution 2. Once that is exhausted, right, then we're in AEP, so we just ate up all our CE&P right here. Then our AE&P is based on chronological order. So in this case, basically all 15,000 of AE&P is allocated to distribution 1, namely the first distribution. This eats up all of the AE&P, going to be nothing left for shareholder 2. So basically in this case, right, shareholder 2 received $15,000, $10,000 comes from CE&P, $5,000 is a reduction of basis, and shareholder 1 in this case has $30,000 of CE&P, and then in this case, right, we eat up all the AE&P to distribution 1 as well. So it's a little bit complicated here. Like I said, if this is tested on the exam, it will be more simple. There might only be one shareholder where you would just draw from CE&P first, then AE&P. It gets a lot more tricky when there's multiple shareholders involved. The next one here, so we just did scenario 1. Now we're going to do scenario 2 where it's plus minus. Well, in this case, basically distributions come from CE&P first. Because AE&P is a negative balance, anything else is going to be a return of capital. Once you eat up the whole basis, it's going to be a capital gain. So let's look at 18.5 here. So this is scenario 2 of 4, where it's positive, negative. Right, so in this case, looks like we have a corporation that has CE&P of 60 and AE&P of negative 20. They're in the hole. At the end of the year, they distribute $48,000 to shareholder 1, who has a tax basis of $24,000, and $16,000 to shareholder 2, who has a tax basis of $10,000. Okay, so we go through CE&P first. In this case, right, we're going to allocate it pro rata. $45,000 to shareholder 1, $15,000 to shareholder 2, right? That total $60,000. Go through CE&P first. Now that that's been exhausted, we have to go to AE&P. However, AE&P is negative, which means anything the shareholders receive from this point is going to be a reduction in basis. So we have here, right, $48,000 distribution to shareholder 1. We said 45 of it is a dividend from CE&P. which means we have a $3,000 reduction in basis. If our basis is 24 and we had a $3,000 reduction, then we have a $21,000 ending basis. So that's the idea here. We have positive, negative, split, go to CE and P first, 60,000, deplete all of that. Then anything remaining after that is going to be a reduction in our basis, where you reduce your basis. So here we reduced it by those amounts. If you were to fully reduce your basis beyond, this was 26,000, then you'd have a $2,000 capital gain. So if you eat away the entire basis, that's what happens. The next one here, negative, positive. So when CE and P is negative, the tax status of a dividend is determined by total E and P on the date of the distribution. So basically what you have to do here is you have to prorate, based on the date of distribution, the negative CEP to the distribution date, add it to E and P at the beginning of the year to determine total E and P at the distribution date. Excess distributions reduce basis. Distributions in excess of basis are a capital gain. So again, this is a mouthful. Let's look here. This is actually taught better through looking at the examples, right? So here is an example where scenario 3 of 4, we have negative, positive. So it looks like a corporation has CE and P of negative 20,000 at year end, and it has AE and P at the beginning of the year of 60,000. Halfway through the year, the corporation distributed $48,000 to shareholder 1, who has a tax basis of 24, and 16 to shareholder 2, who has a tax basis of 10. Okay, so what we're doing here, CE and P is negative. In this case, we have negative, positive. So we have to determine our total E and P on the distribution date of 6/30. So this is kind of prorating it. So as we have here, right, this requires the corporation to prorate the negative CE and P to the distribution date, and then add it to AE and P at the beginning of the year. So let's do this. Let's prorate the negative CE and P first. So negative 20,000 as of the distribution date, halfway through the year, right? Then we add it to AE and P at the beginning of the year. It's going to get us 50, right? Then what you do here is you have your total E and P at 630. You're going to allocate it, based on ownership percentage here. So 37.5 is a dividend to shareholder 1. 12.5 is a dividend to shareholder 2. We have here, right, 48 was given to shareholder 1, which means 37, and we had 37.5 that we allocated here, which means 10.5 has to be a reduction in basis. So basically here we have 24 is our basis, reduce it by the 10.5, gives us the 13.5. So this is kind of showing you here, right, of the 48,000 and the 16, right, that were given to shareholder 1 and shareholder 2, you can see that, the 48,000 is right here in this amount. Basically, right, 37.5 is a dividend and 10.5 is a return of capital. 12.5 is a dividend, 3,500 is a return of capital. So if you just think that high level, when we started out simple, right, we do first dividend, then we do return of capital, then we do capital gain. Where you really have to apply the rules to determine that outcome is like plus, plus minus, depending on the situation. Now our remaining AE and P balance, so if we had 60, we took out 10 for the prorated amount, we had $50,000 of dividends, and then we had 10,000 prorated for the last 6 months of the year is going to give us an ending balance of $10,000 in AE and P. So again, this one is the third situation. We have minus plus. We have to prorate the negative CE and P based off the distribution date, add it to AE and P at the beginning of the year, and that helps determine total E&P. Then you go from there, you determine dividend, return of capital, capital gain. Finally here, right, we have minus minus. So this is when both CE&P and AE&P are negative. None of the distribution is a dividend. Thus, this distribution in this scenario will be a return of capital. Obviously anything in excess of your stock basis is going to be a capital gain. So let's look at 18.7 here. Okay, so we have negative, negative. So corporation has CE&P of negative 50, AE&P at the beginning of the year is 60,000, negative. Shareholder 1, tax basis 24. Shareholder 2, tax basis 10. On 12/31, the corporation distributed $48,000 to shareholder 1 and $16,000 to shareholder 2. Okay, so we know it's negative, negative, so that means there's no dividend here. Basically, all we're going to do is eat away at our entire basis. So in this case, right, we have $24,000 basis. We receive 48. The first 24 is going to deplete our basis. The remaining 24 is going to be a capital gain. So of the 48 we received, 24 reduces our basis. 0 is a dividend, 24 eats away at our basis, and 24 is a gain. Same over here with shareholder 2 basis. They receive $16,000, so 0 is a dividend, 10 reduces basis, 6 is a capital gain. So you can see here, right, if we were to look at these, the fourth one is if you want to just try to like keep it in your head, like somewhat simple. The third one is like the most complex. It's where you have to like prorate it based on the date. The fourth one is the easiest, right? You just no dividend, reduced basis, capital gain. The first one isn't that bad. That was let's see here, scenario 1 of 4. This is where we just broke it out and showed it. And then the second one isn't that bad either. I mean, these aren't like intuitive, but basically if you can just keep it simple in your head, right? What we're trying to do here is to determine whether a distribution is a dividend. That means it comes from earnings and profits. However, because we have 2 earnings and profits accounts, we have to look at those specific accounts in order to say how much of this distribution is a dividend, how much of this distribution is a return of capital, how much of this distribution is a capital gain. And remember, we said easiest, probably second easiest, third easiest, and then hardest. Just kind of nuanced rules there for what they're doing. So continuing here. So as I have here, right, it's possible what we've looked at so far are distributions of cash, right, in light of CE&P and AE&P balances. Where it gets even more tricky is when there's distributions of property, something other than cash. Maybe the corporation, distributes a machine. Why this is more complex is because 1, the property that's distributed could have a liability attached to it, like a mortgage or a loan. And then 2, the difference between the fair market value of the property and the tax basis of it, that actually affects E&P, which affects the way it's calculated here. So the measurement of the property of the distribution, basically when you're measuring, you're looking at it, it's going to be your cash plus your fair market value minus any liabilities you assume on it as the shareholder. And then generally, from a shareholder's perspective, their tax basis in any property they receive from a corporation is going to be the fair market value at the date of distribution. And interestingly here, the liability assumed, if the shareholder assumes that liability, like the mortgage, the note, the loan, on the property that's distributed, this will not be factored into the tax basis calculation. So let's look at 3 different examples here. So corporation distributes cash and a bike to shareholder 2. The corporation has CE&P of 100,000 and no AE&P. What is the treatment? Basically, you just have positive and then, 0 or negative. You always eat up CE and P first. So in this case, right, you take 15,000 from CE and P, 1,000, the fair market value of the bike. That's how much is going to be treated as a dividend to the shareholder. That's like the starting point, right? Next thing here, this is just showing, the same idea here, except now it's looking at the basis in the bike. Generally, right, when you receive property from the corporation, you're gonna take a basis of the fair market value. Now this one is showing a little bit more of a complex situation of it. So it says, hey, a corporation distributes land with a fair market value of 60 that has a $12,000 mortgage attached to it. CE and P is 100, and there's no accumulated earnings and profits. What is the treatment for shareholder one? Okay, so when we're measuring it here for purposes of the dividend, we're going to use this equation. So 60 is the fair market value minus the 12, the liability that's attached to it that we, the shareholder, assumed. That means we have 48,000 as a dividend here. Again, you're just eating away CE and P first. And then our tax basis in that land is going to be the entire 60. For purposes of that, we ignore the liability. That's what's going on down here. Our basis is the fair market value. Do not factor in the liability that's assumed. Continuing here, so we have, maybe 5 or so slides left. This is like a pretty in-depth chapter. So tax consequences, I have here the distribution of non-cash property can affect taxable income and CE and P of a corporation, right? So that's because the taxable income here, that is to say gains, are recognized by the corporation on the distribution of non-cash property. If the corporation has a gain from the distribution, this increases CE and P. However, for E and P, the gain is calculated using the E and P basis. Okay, that's a mouthful. What we're saying and what we're going back here is we're going to this point right here. We said things get more complex when you have a distribution of property other than cash, because it affects the calculation of gain. So let's look at 1811 here. So similar to the previous setup, we have a corporation that distributes a bike with a fair market value of 1,000. And let's assume that the corporation has both a tax basis and an E and P basis of 650 in the bike. Well, in this case, right, we previously talked about just what amount is the dividend, what amount does the shareholder take in a basis of it. Now we're looking at, and it didn't really matter because we had enough CE and P to just eat away at the entire thing. It didn't really come up. Now we're looking at the corporation's perspective from it before we looked at the shareholder. So in this case, basically the corporation pushed out something worth 1,000. They had a 650 basis in it. They're going to treat that like a gain, a $350 gain. That increases CE and P by that amount. So, you're going to, again, increase your taxable income by the 350, going to give you a 7,350 tax liability on the gain. Next, we have the corporation distributes a bike to shareholder 2 with a fair market value of 1,000. The corporation has both a tax basis and an E and P basis of $1,200. What is the treatment for the corporation? Well, in this case, again, we're looking from the corporation's perspective. We only look at the gains here. This $2,000 loss would not be recognized. So that's what I have. As shown, if the corporation pushes out the bike as a distribution, cannot recognize the loss. In this case. So again, if we were just looking at 18.8, 9, 10, and 11 here to build off it, we just said first, from the shareholder's point of view, how much was the dividend? From the shareholder's point of view, what basis do they take in the item that's being pushed out? And then we build on that again. What basis does the shareholder take? Then we look from the corporation's point of view, right? Does this gain, how does this affect the corporation's E&P with it? That's what we've been doing here. Next, right, another idea we're going to build off with this is the liability assumed by the shareholder on property received. Okay, so the shareholder receives a piece of property, they assume a liability on it. This can affect the gain that's recognized by the corporation. As I have here, right, if the liability by the shareholder is greater than the fair market value of the non-cash property distributed, then the fair market value is deemed to be the liability assumed by the shareholder. If the liability by the shareholder is less than the fair market value of the non-cash property, the gain recognized on the distribution is still the excess of the fair market value over the tax basis. This is like beyond the scope of what I'm worried about for the exam. I'm more worried about these simple ideas here. What's the basis? What amount is a distribution? We're talking about distributions of non-cash property. Things I would worry about is how much of it is a distribution using a simple example, or how much of the distribution is a dividend using a simple example. What basis does the shareholder have? From a simple example, how could this affect the corporation's E&P and their taxable income? So you can look at this here as discussed. The distribution of appreciated property results in a taxable gain for the corporation. And basically what they're saying here is if the tax basis of the property is the same as the E&P basis, the gain is going to be the same. However, what they're really saying here, and what this is just really focusing on, is there could be a difference, right? And there probably will be a difference in practice between your depreciation for your tax return and your depreciation for E&P, right? For the exam, don't worry, there's not going to be any kind of difference, in the calculation. But just be aware, right? Remember E&P, they use that ADS system on their tax return. They, maybe use bonus or 179. So it's really going to change how you would calculate that gain or loss in that case. But again, I'm just worried about the basics. This is really going down the rabbit hole here. So this is showing you here, those three scenarios, the multiple scenarios you could have. Now, we just talked here about, right, the four situations. I would be more concerned for the exam, with these guys right here, and then the basics of the non-cash distribution, than all of the nuances of liabilities and things like that attached to it. So the next few slides here, we're going to be talking about stock distributions. So let's see here. We have 16 slides? No, 14 slides left. Let's pause here. I think that's enough. That'll give us the remaining, 24 through 39. So that's about 15 slides for the last lecture. This is pretty heavy stuff. So let's pause there and then we can pick it up here for the last lecture.